a 4-part strategy for investing through a Black Swan event. Now, there's one thing that I've learned over my investing career, and that is that there's no such thing as good and bad timing, but rather there's good and bad strategies. As an investor, as somebody who's putting your hard-earned money out into the market to hopefully increase it and not lose it, you need to have a framework to follow. You need to have a strategy to follow. You need to have an edge. If you don't know what your edge is, that means you don't have an edge. But that's okay. I got your back. I'm going to give you a framework that you're going to need to navigate a Black Swan event because, of course, we have almost an unlimited amount of potential black swans that are sitting outside in this world ready to crash the markets again. And so let me give you this 4-part framework in this video. I'm going to show you what the 4 parts are. I'm going to show you some historical reference so you can see how these have worked in the past. I'm going to show you how you can navigate this, what assets will work, how you can see where the money's flowing, how you can position yourself to receive from that, and a whole lot more. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong. Everything they're telling you is wrong, but that's okay. I'm going to explain it for you so you can understand this. Now, the first thing, like I said, we're going to talk about these strategies, these frameworks that you can follow in order to learn or to better navigate and invest through these Black Swan events. All right, so the first thing you have to do is you have to understand how the market formations work. And you have to understand that the markets form in different ways through different types of structures and different types of events. And there's different stages of bubbles. Now, a question that a lot of people would ask is, are we in a bubble or that's a bubble? That's not the right question to ask. The right question to ask is, what stage of the bubble are we in? Everything's in a bubble. Is it just forming? Is it peaking up? Is the bubble about to burst? And so everything's always in a bubble. What stage are we in? That's important to understand. And you have to understand that as they inflate, sometimes they just deflate and sometimes they bust. And so you have to understand the differences of the deflation and the bust. And then, like I said, I want to give you a framework, and we're going to go over a framework called Ka-Poom. Now, this framework is from a venture capitalist. It's not my framework, but I think it's good for a teaching lesson. We're going to break it down. I'm going to show you how to follow this framework if you want to be successful like a venture capitalist. Now, it's called the Kapoom Theory, and I'm going to break it all down for you. Don't worry. The Kapoom Theory, what it is, it's a theory that postulates how the asset bubble cycle works. Remember, we have to understand how the cycle works so we understand where we're at and how to invest through that. Meaning how bubbles are created, how they're destroyed, and more importantly, how they're reborn. And so a lot of times people see when the markets deflate or crash, they see that as disaster. They're scared, they're worried. But the reality is it's massive opportunity if you know what you're looking for. And that's this piece here, how it's reborn. So we're going to take a look at that. I'm going to break this down for you, like I said, give you some historical examples. But we can see basically, actually, I'm not going to go into that right now. I'll bring that back in a minute. All right, so the problem. First, we have to start with the problem. The problem is that all we have throughout history is a history of bubbles. Booms and busts, booms and busts, booms and busts. We can see, if I blow this chart up so you can see it a little bit better, you can see here back in the 70s, we had a gold bubble. We had the Nikkei index bubble. We had the Thailand bubble. We had the tech stock bubble in 2000, of course, the dot-com boom and crash. When all of that money left the dot-com boom, where did it go? It went to the real estate or the US housing bubble crash. We had a China bubble crash. And the last one we have now, some people call it the everything bubble, but really we've seen this bubble in the disruptors or the tech stocks. They've gotten greatly overvalued. Now, I've used this chart before, but it's helpful to bring it back up one more time to understand the psychology of how this works and how these bubbles form. And so at the bottom, which would be over here, you have a stage of disbelief. These markets will never come up again. Then we have optimism. Wow, things are going really good. I feel pretty good about this. Then belief. Wow, this is for real. Everybody should be investing. My friends, my family, everybody needs to get in. Then we have the thrill. I can't believe how much money we're making. You're missing out. FOMO. We have this euphoria. I can't believe it. I'm going to be rich. And then the crash. What happens is it dips and it bounces. This is an important area to understand. We'll come back to this dip and a bounce in a minute. And that's the complacency. Well, I think it's coming back. Let's just wait and see. And then the anxiety. Oh, shoot, it's not coming back. Denial. This can't be true. I know it's coming back. The panic. Oh my gosh, I'm going to lose all my money. And then the capitulation. I don't care if I'm only getting 20 cents on my dollar. I'm going to sell out now. So it's important to understand the psychology of that so you can navigate these That's why I bring that back. But the one thing I want to break into, because it's part of this framework, is you have to understand what drives these booms and, of course, the busts, and then the rebirth. That's the key piece here. And so they all follow that predictable pattern we looked at, but really the problem is government intervention. All right, so we can see, now it's the problem, but it's also a solution if we want to invest through it properly. So this red line that we have right here is 1913. That's when the Federal Reserve was created. It's important to understand that because there's always booms and busts. You can't know joy without pain. We have seasons. We can't always be flat. That's a problem that we have in the world today. We're trying to take away everybody's pain. Pain's necessary. Pain's a signal. And again, like I said, without pain, we can't know joy or pleasure. And so we have to know both. And so we have seasons. We have booms and busts. People's interests, their wants, their needs, their desires, they change. And so people over-speculate, people buy too much of inventory, and then nobody wants it. And so we have booms and busts. They're natural. The problem is when the central bank gets behind it and they start to artificially stimulate this, then they start to drive all types of malinvestment, and then they make things really bad. And you can see the booms and busts were always here before the central bank, but look how much bigger the booms and busts have gotten since the central banks have gotten involved. That's the problem, but we can't fight it, so we have to join them. And so that's also our framework for how we want to invest. I'm going to break that down for you. All right, now the four parts, I'm going to break these down one by one, but the four parts are the bubbles created, okay? The bubbles created as a result of interest rates being kept too low by the central banks. That creates way too much money. I'm going to break all this down for you. Step number two is that the bubble begins to deflate at some point. At some point, people's wants, needs, desires shift, and so the big boom starts to deflate, it starts to bust. But as it's starting to deflate, we have a black swan event, a big event that happens that then pushes a hole in that bubble and it starts to deflate rapidly. Then the central bank will respond to the disinflation with inflationary policies that have a 12-month lag. I'm going to break all this down. I'm going to show you examples of it. And then the strategy then is the Kapoom part. It's the subsequent reinflation of the money supply. All right, so let's break all this down so you can understand how to invest through this. So step one, the bubble's created, right? We talked about this. So the central banks hold the interest rates too low. So here's an example of the Federal Reserve of the United States, the federal funds rate. This is the price of money. A lot of people don't realize this, but you actually buy money. You use money to buy things, but we also buy money. For example, if you want a house, you need to pay whatever, $100,000 for the house. You don't have $100,000. So you have to go buy that $100,000 to get the house. The price you pay for that $100,000 is the interest rate. And so by them setting this price of money, they drive everything. They've set the price of everything. And when rates come down, it encourages borrowing. People borrow more money. We live in a debt-based system, so we talk about the money printer, but the reality is that the banks create money through issuing loans. So when you buy a house, a car, a boat, etc., that money is created into existence through that loan. And so when interest rates come down, people borrow more. When interest rates go up, people borrow less. So you see that. And so you can see how rates have come way down. This is the Volcker moment we talk about in the 80s under Reagan. 1990, the rates started coming down. And these gray lines here, these are busts. So you can see every time there's a bust, what do? They drop the rates. They drop them, they finally start trying to bring the rates back up, and what happens? Oh, it creates another recession, so they drop the rates some more. They start trying to bring the rates back up, but they can't really do it, and then they create another bust, and they have to drop the rates some more. Now they try to bring the rates back up, but what happens? Yep, it creates another bust, and so they have to drop the rates more. Are you starting to see a pattern here? And so they've kept the rates since about 2010. They've kept them basically at zero. They finally started to try to get them back up again, and what happened? That's right, another bust, and here we are again. So they keep them too low for too long, creates way too much money expansion. Now we can see this also illustrated in this chart right here. And this shows the total assets of the central banks, basically the Fed, European Central Bank, the Bank of Japan. This is the blue line. So we can see the assets of the central bank are going up, and the red line is the S&P 500. Now, it's no coincidence that the S&P 500 moves up almost exactly with the assets of the central bank. Are you starting to see a correlation here? So you can see this moves when we have this big move up in the central bank balance sheet. We have a big move up in the S&P 500. Now, I'm not going to go into that chart. We'll break it down a little bit better in a second. All right, so now we have the next step. So the next step is number 2 is deflation. Remember, this just happens. People's incentives, people's motivations, their wants, needs, desires, they shift. We're humans. We're irrational. And so the bubble eventually starts to deflate. We invested too much into one thing, etc. And let me give you an example of this so we can actually see how this works. So a lot of people think that the 2020 pandemic crash was a black swan event, which it sort of was. But the deflation was already happening to the point we're talking about. The deflation is already happening, then a black swan event comes in. What do you mean by that? Well, we can see here, this is dated in 2019, obviously before the 2020 crash. In 2019, the yield curve inverted. Now, we've talked about this extensively. If you want more videos on the yield curve, you can leave me a comment down below. While you're commenting, you could also click that like button so more people see this video, and while you're at it, hit that subscribe button if you don't mind. That way you know when I put videos out. All right, so in 2019, the yield curve inverted, and that means that a recession would hit in 2020. When the yield curve inverts, it tells us a recession is coming. So it happened in 2019. We knew that a recession was going to come in 2020. It was a black swan event with the pandemic and the lockdown of the economy, but we already knew the recession was coming. It was already deflating. The bubble was already deflating. Then the black swan event showed up. The black swan event doesn't need a lot of explaining. Of course, we can see here the coronavirus crash of 2020 and the investing lessons it taught us. So when it was already deflating, we had that black swan event come up, which of course put the whole world into a tailspin lockdown. And we're dealing with that now. This says the world economy will experience the worst recession since the Great Depression because of this, and we're just starting to experience all of that right now. And you can see that it led to one of the fastest and sharpest drawdowns of the markets in history. As a matter of fact, the S&P 500 lost 35% in 4 weeks, which is amazing. It's not always the amount of the drawdown that we want to look at. We also want to look at the speed in which it moves. Now, this is kind of an example of different drawdowns that we've seen, and you can see this March of 2020 was the most extreme. Usually these drawdowns happen over a much longer period of time. So this one is very severe, and that was because of the deflation and then the black swan that hit. All right, now step number 3. This is where things start to change for us, and we want to pick up on our framework, our strategy for investing through this. So it's the central bank's response to that. The bubble's already deflating, the black swan hits. What do the central banks do? Well, the central banks do what the central banks do, which is stimulate. When all you have is a hammer, the whole world looks like a nail. When all you have is a money printer, you're looking for any excuse that you can to use that money printer. So the central banks do what they do. They stimulate, and of course they did that in spades. We can see here the total assets held by the Fed. We can see this shot up like almost like a hockey stick, we call that. We can see here a better chart. This is the M2 money supply monthly percent change. So this is the percentage change in how much it's growing, and you can see how it went up like that. And if you want to see the numbers, it says right here that the money supply measured by M2, which is the Fed's broadest measure of money in the economy, has been growing at record rates, of course, 40% cumulative growth since February, 40% increase in the broad money supply. So that's what they do. The central banks do what they do, which is create money. But what happens? Well, within 12 months later, you start to see the effects of that money. And of course, we are seeing that now with massive inflation. Biden finally concedes. Remember, we don't have inflation. Inflation's transitory. It's Putin's fault, all of those things. But he finally concedes that the stimulus policies is really what led to the spike in inflation. Now, let's look at this chart. I got this one that's pretty cool. And this shows all the different stimulus packages. So we got one stimulus package here. The blue lines is inflation. So you can see inflation had been pretty low. and about pretty even. You can see that it's pretty even. It dropped a little bit in this pandemic, and then it started picking back up, but then look where things went off the rails. And what we can see is that we had a $1.9 trillion stimulus plan here, a $2 trillion plan here, another $500 million here, almost another billion here. And what we can see is about 12 months later, look what happens. So you see this framework plays out very well, and with all the potential black swan events that we have in front of us today, we're going to need to dust this playbook off, and we're going to need to use it. We can also see in this example right here, this is the S&P 500, I'm sorry, this is the NASDAQ, which are the tech stocks. And so what we can see, here's the March of 2020 crash. And so where all this stimulus started happening here, 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 about 12 months later, you can see how overvalued the market began. One interesting note that I saw when I pulled this chart out, by the way, not to do with this video, but you can see this trend line. So this is going all the way back here till 2008. And look at the NASDAQ has been following this trend line. And it only dipped below the trend line right here for the March 2020 crash. But look right here, the market is respecting this trend line right here. Maybe things aren't as bad as we think it is, but that's a topic for a whole other video. Leave me a comment if you want me to do a video just on that alone. Okay, and now we get to the fourth and final step of this four-part strategy, this framework that you can use to invest through black swan events. And the fourth part is to follow the money. Remember, part 3 was the central banks start dumping money into the system. And so all you need to do is find out where that money is going to be, open up your arms, and receive it when it comes. Sounds so easy, right? Well, let's take a look at that. So the fourth part is follow the money. This is the Poom part of the Ka. The Ka is the deflation in the black swan event. The Poom is the result of that when the central banks dump a bunch of money in. And the Fed, the central banks are who dictates which sectors that money is going to go into. So all you have to do is look at their policies and their plans, and they're going to tell you where that money is going to go, and all you got to do is get there in front of that money. Sounds so easy, but let's break this down. So let me show you an example of how that works, first of all. So what we can see is in the 2020 crash, using that as an example, the market was deflating in 2019. The pandemic was the black swan event, the crash. The Fed then jumped in, step number 3, and started stimulating. And what did they do? Well, they were buying mortgage-backed securities. As a matter of fact, they were buying the largest amount of weekly purchases of mortgage-backed securities that we had ever seen. You can see how high this was, 178, almost $200 billion. They were also buying, they created special purpose vehicles, SPVs, and they started buying corporate debt. And you can see the amount of corporate debt they were buying here back in that during that height of that pandemic. They've since tapered down a little bit, but we can see here that the Federal Reserve is buying corporate bonds. So they're pumping up the stock market. Basically, they're keeping the companies propped up so they don't go out of business. So what do you think happens? Well, if you think that their valuations go up, you might actually be right. So let's take a look at that. What we can see here is that the markets rebounded from that pandemic. The NASDAQ, the red line, shot up the highest. So they start buying up the bonds, they start propping up this sector, they make money really cheap by lowering the interest rates, and that sector blows up. We also saw the real estate market blow up. Surprise, surprise. It shows that home prices increased by 11.3% in 2020 and another almost 16% in 2021. So we saw almost a 30% increase in homes nationally. Some areas saw as much as 100% increase in homes because of the stimulus that went into homes and went into the corporate markets. Are you seeing that? So now that you understand how that works, we have to ask ourselves, what comes next? Well, I'm glad you asked. Let's take a look at that. So we need to use this framework, all right? So we can see right now that volatility is increasing. As a matter of fact, we just had the second negative GDP print. The GDP numbers came out negative for the second time. That means we're technically in a recession. Things are extremely volatile. We have all types of black swan events out there. The bubble's deflating. We can see the S&P 500 is down, the NASDAQ down, housing's going down. So everything's in a deflationary event, and we're waiting for this black swan event. What's going to be that bubble? Well, we got China, Taiwan, we got oil situation, natural gas situation, we have Russia, Ukraine, we have famine situation, we have all types of black swan events, potentially nuclear war, potential civil war in the United States, World War III, you name it, no shortage of events. Now, So we know that we're in deflation. We know there's black swan events sitting there, out there everywhere. And then we know the feds will jump in. And I believe that the next response is going to be way bigger. So in 2008, it was about a $700 billion response. In 2020, it was about a $7 trillion response. In 2023, it could be a 10 or 20 trillion dollar response. And so what we want to do is we want to watch for the government policies. And let me show you what we're looking at here. So just as an example, real quick, I want to show you this. This is in Weimar Republic of Germany, one of the greatest examples of hyperinflation. We love to look at it. And what we can see, this is their currency, the German mark, priced in gold. Okay, and so the black line shows us the Weimar mark priced in gold. And you can see that in 1914, if you would have cashed out all of your marks and bought gold, and you would have held them through till 2023, about 9 years later, you would have made an enormous amount of money. Look how well you would have done. But the red lines on the chart are the volatility. So while it looks like all you had to do is buy here and hold for 9 years, and you would have been a genius, the reality of living through that was very difficult because it was going up and down. The price was very volatile, and so people were getting shaken out of their positions. And we can see that over time, the bailouts have continued to get bigger and bigger and bigger. So this is like a savings and loans bailout in the late 80s. We have the Mexican peso crisis. Here we have the GFC response. You can see how big that was. And then you can see here's the pandemic response right here. So you can see the debt keeps on growing, but the size of the bailouts to keep the bubbles from deflating continue to get bigger and bigger and bigger. All right, so where is the money going to go? Simple question. And actually, it's pretty easy to find out. So there's something that just popped up today at the time of this recording. And so we've been hearing about this build back better, this new Green Deal, this green initiative. They want to spend trillions of dollars to rewire, reconfigure the entire world, to push all these new policies. And it's been kind of dead. And it's been dead because of one Democratic senator by the name of Manchin. And he has been basically crushing it. Manchin delivers the crushing blow to the Democratic agenda. This was just in July 15th. So Manchin's like, no, I'm not going along with this. I don't care if I'm a Democrat. These policies have created way too much inflation. The people can't afford food. They can't afford gas. There's no way I'm going to agree to this spending package. Well, that was July 15th. And as of today, time of this recording, Manchin has changed his mind. Now it's build back Manchin, he says. Here's what is included in the monster spending deal agreed to by the Democrats. So Manchin caved. Manchin agreed to throw his cast his vote in and build back better. The Green New Deal is back on. So where is that money going to go? Well, it's pretty easy to see. It's going to go to medical, pharmaceuticals, bio. It's going to go to green initiatives. So it's going to go to rewiring, reconfiguring, electric vehicles, energy efficient housing, and it's going to go to energy, climate, and medical. Those are the three areas laid out in this bill. So they're telling us what's going to happen. We can see we're in deflation. We can see the Black Swan events on the horizon. We can see their spending plans lined up. And all we have to do is position ourselves with open arms to have that money come in. It's that easy, right? Maybe not that easy, but sort of. Leave me a comment and let me know what you think. Is it that easy? Just so you can just say yes or no. Of course, as always, give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down. That's okay. But at least tell me why in a comment. And while you're at it, hit that subscribe button and that bell notification so you know when I put new videos out. And that's what I got for you today, all right? To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.